Hey friends, welcome to another video on this channel. Today I want to go over what is a money market fund. I have wanted to tape this video for quite a while and now is finally the time. So I will cover the basics like how it works, what the benefits are, what type of money market funds exist, and how to invest in one. To understand what is a money market fund, you first need to know what a fund is. In a very simplified definition, a fund is a type of financial product of which many investors contribute their money. It will have a team and a manager that collect the money from these investors and invest it in the different types of financial products that are aligned with that fund's purpose. There are different types of funds out there, but a money market itself will be composed of what we call of safe investments. This will be treasury bills, commercial paper, and certificates of deposit. These financial products are part of the bond category and they serve a very similar purpose, which is to raise money for projects. When a government or a corporation wants to raise money, whether it is for building new roads, buying new equipment, developing new technologies, hiring more employees, and so on, whatever the project may be, they will issue bonds with the promise that, hey, if you buy this paper, I promise to give your money back plus interest. So when you buy a bond, you are lending money to the person who issued that bond. So when you buy a treasury bill, you lend the money to the government. When you buy a commercial paper, you're lending money to corporations. And when you buy certificates of deposit, also known as CDs, you're lending money to banks. And they will pay you back the amount you lent plus interest. Now, if you're lending money, you probably want to know when you will get paid in full. Would that take 2 weeks, 6 months, 2 years, or 30 years? The bonds that compose the money market funds are short-term bonds, meaning that they have a maturity date of less than a year. Some of these bonds will mature in a couple of weeks, others in a few months, but they will never exceed a year. So how a money market fund works is that the manager and their team will invest in these short-term bonds. And as these bonds mature, the fund will distribute the income earned from the interest paid between the investors according to how many shares each investor owns. Now, when I say that a short-term bond matures in less than a year, it doesn't mean that you will have to wait 30, 40, or 50 weeks to receive your slice of the income earned from the interest paid, because there will be bonds maturing all the time from way before you bought a share. That being said, a money market fund must inform its investors how long it typically takes for their bonds to mature. This is called an average maturity date, and it typically takes less than 60 days. What are the benefits of investing in money market funds? Before I go into this part of the video, there is something you need to understand, and this may actually be a game changer for many people. I need you to understand that there is no such thing as a good or a bad financial product, because every type of investment will serve a specific purpose. And why am I saying this? Throughout your life, you will find yourself at different levels and stages. The moment that you become responsible for your money, you start by ensuring that your basic needs like food, housing, and transportation are covered. Once that is taken care of, you start building an emergency fund. Next, you begin accumulating wealth, building an investment portfolio, saving for the long-term goals, reaching financial freedom, and so on. Each of these stages in life will require a different type of financial product. If you're saving for retirement, there is an account, stocks, and bonds for that. If you plan to get married next year, there will be financial products for that. If you have kids and are investing for their education, the same thing happens. You got the idea. So what I mean by all this is that whenever you watch or read any type of financial content, ask yourself, what stage in life do I find myself in? What are my current necessities, and how can this investment fit in? Because by doing this analysis, you will figure out what financial product will be ideal. Well, I didn't mean to get off topic, but this is something that you need to keep in mind, and I can't stress it enough. Now, back to the benefits of investing in money market funds. First, we have the low risk factor. Money market funds are composed of short-term debt securities, a fancy name for bonds, and these securities promise that the amount you have invested will remain intact and will be preserved. Now notice that I didn't say they are risk-free, because not even the money hidden underneath your bed is risk-free. But overall, the chances of the value of the money you have invested in a money market fund decrease is very, very low compared to all other financial products. The goal of this type of fund is to keep the value of each share at $1. So if everything else in the economy remains constant, if there's no major market turmoil, and if you got one share, it will have a stable price of $1. If you got 100 shares, that's $100. 3,000 shares, $3,000. And regardless if you are buying or selling it, that will be its value. You will often hear people referring to a money market fund as a cash equivalent due to this factor, and also because they are liquid. Liquidity means that it's easy to access your funds, there is no penalty, and the amount you have invested is most likely to be preserved. However, I don't like to call it cash, because cash for me is something that I can have access to immediately. To withdraw your money from a fund, you will have to sell the shares, which are only sold at the end of the day, and then you will have to let the transaction settle and transfer it to your checking account, and this process could take you 2 to 4 business days. So it's easy to access your money, but it's not the same as having cash. Something else I must mention is to not confuse money market funds with money market accounts. There are some differences between them. The main ones being that a money market account is offered by banks. You can open an account with your local or online bank, and these accounts are insured by the FDIC. A money market fund, which is what this video is about, is a financial product. It's an investment managed by an investment company, and they are not insured by the FDIC. Now, regarding the interest rate, at the time of this taping, money market funds are yielding around 4-ish%, between 4 to 4.8%. This is a lot for a low risk investment here in the United States, and at the moment we can find this good rates because of our current economic environment. Another characteristic of money market funds is that they are organized and separated into 3 different categories. Do you remember that I said there are different types of bonds a fund invests in, like treasury bills, commercial paper, and certificates of deposit? So there are also some other types of securities held in a fund, and it will follow this order. There are government money market funds, which will be composed of short-term government securities. There are prime money market funds composed of short-term securities of high-quality corporations. And there is the municipal money market, which is composed of debt securities issued by a state or a local government. Something nice about the municipal funds is that the income you receive from the interest is tax exempt. You don't have to pay federal income tax, and in some cases, if you live in the state where the bond was issued, it could also be exempt from state income tax. Now, let me give you an example of each. To invest in a money market fund, the first thing you have to do is to sign in to your brokerage account with whoever you have an account with and see what they offer. I will show you Fidelity, and I will start with their government money market fund, the SPAXX or SPAX. So this first screen is a summary of this fund. So we can see that it is taxable, it is a government product type, and it was created in 1990. There is a expense ratio of 0.42%. What is an expense ratio? Remember that I said that there is a team managing the funds? Well, they won't do it for free, and this is what that expense is for. So what you will have to do is to take the return of the fund and subtract the expense ratio to figure out how much you would actually earn. For this fund, the yield is 4.48%, but when you deduct the expense ratio, you are actually at 4%. If you are new to this, you're probably asking yourself what this 7-day yield means. This tells us that over the past 7 days, the fund's average annual return was 4.48%. This number is annualized. It's not telling you that you will receive 4.48% on your investment in 7 days. Got it? Moving on. The minimum amount required to invest in this fund is $0, so there is no minimum amount. You can start with whatever you got available. They go on to show you how much money is under this fund's management and if the value of the share has remained stable over the past 12 months. Another piece of information we got here is that this fund has so many assets under its management that it takes on average 17 days for them to reach maturity. I went over this at the beginning of the video and explained that on average it typically takes 60 days. Well, here we got 17. And why is this important? Because the longer the average maturity date is, the more sensitive the fund will be to interest rates. And lastly, what everybody should do is double check what the fund is composed of and look at who the managers are. So if you were interested in this fund, you would log into your Fidelity's account, you would type specs and invest how much you want. For the Prime Money Market Fund, let me show you Schwab's SWVXX. As a prime fund, their holding will consist of bonds issued by high-quality corporations. The type of information that we will get here is the same. The only thing that will change is the number. So for this one, the 7-day yield is 4.67%, which is slightly higher than the government fund we just saw because this one offers a little bit more of risk. Because think about it, between a prime and a government fund, the prime fund will be riskier. So to incentivize investors to purchase their shares, they need to offer a better return. Otherwise, investors will stick with the government fund. The expense ratio for this one is 0.34%. There is no minimum amount required to start investing, and the average maturity of the fund is 14 days. For a municipal fund, the information you get will be the same. Let's look at Vanguard's New York fund. The ticker is VYFXX. I like the way Vanguard displays its information because it's more pleasant to look at. So this is a municipal money market. Their expense ratio is 0.16%, the lowest expense of today. The 7-day yield is 2.07%. Why is this one so low when the other two were around 4.5%? Municipal funds will have a lower return because they are tax exempt while the others are not. So this is a 2.07% tax-free on your investment, and depending on what your tax bracket is, a municipal fund might make more sense instead of having to pay a high income tax on a 4% return. Do you see now why there is no good or bad financial product? Because it all depends on what stage you are in life. Now, this fund has a $3,000 minimum requirement to get started, so there is an entry barrier right there. Not everyone will be able to get started with this one. And from here on, you can go and check the other information like the portfolio composition and the average maturity, which for this one is 9 days. So I have shown you 3 options for money market funds, but there are so many others you can search online or on your brokerage account. And after this long explanation, you might be asking yourself, when or why would you invest in one of these? I use money market funds for my short-term goals. This is money that I'm saving for a vacation next year, a car I would like to buy, or any other goal that would take me 1 to 2 years to fulfill it. I also use it to park cash that I don't need to have in my savings account. So for example, I usually keep some money for emergencies in my high yield savings account because I can access it right away. The other part of my emergency fund and the money that I will use for future investments, I leave it invested in a money market fund. This is usually what this type of fund is used for. Is this the only type of financial product that will serve the same purpose? No, here in the United States, we have a lot of options, each of them with their own rules and limitations, the same way there are different diets out there for all tastes and needs. If you found value in this video, please give it a thumbs up. And if you're new to the channel, don't forget to subscribe. I hope you enjoyed this video and I will see you next time. Bye-bye.